Now, speaking of Kenya, its debt ratings are coming under pressure as the country continues to scramble to secure external financing to settle bonds and syndicated loans that are due all the way up to 2027. However, the country is unlikely to default, at least according to analysts at Bank of America Securities. Kenya, as you might recall, secured $1.4 billion in disbursements from the World Bank and the IMF in June and July. Tatonga Rusike from Bank of America Securities says that the country needs to build up its gross reserves to at least 4.5 months of import cover, or about $8 to $8.2 billion at current levels. During his nomination hearings, Kenya's current central bank governor floated the idea of issuing a local dollar-denominated bond. Just last week, however, he argued the need for it now may have reduced a bit.
This is still an area that is under discussion. We will cooperate with the National Treasury as well as with the banking sector. But having said that, I think it's important also to note that with the new Dow CSD, that even Kenyan diaspora will have access to these treasury bonds as well as treasury bills, and therefore the need maybe even for issuing a local dollar-denominated bond. We'll have to see whether that is still necessary. But I do believe that with the new system that we have put in place, that there'll be more people and more Kenyans abroad who will be able to access these securities, and therefore we should be able to increase our dollar, the dollar inflows into the economy.
So that's the expectation, the ability to draw dollars into the market. But remember, the three major ratings agencies all have negative outlooks on Kenya at the moment, given the challenges of raising capital to settle the 2024 Eurobond, among other facilities. A downgrade from Fitch and S&P, those are pretty much priced into the bonds at the moment. But Tatonga points out it would be a concern if Moody's downgrades Kenya to CAA1. Now, some hours ago, I spoke to Mark Boland. He's a senior credit research analyst at Red Intelligence. I started by asking him if the central bank governor's comments that the Eurobond due next year can be paid off out of reserves if necessary will provide investors a little bit of comfort.
Central Bank of Kenya has struggled to keep the FX reserves above the 4 months of imports, but this is definitely less of a problem than actually having to default on a bond. So the CBK funds are there. They actually do have the funds to repay the Eurobond in full if they need to. This will be considerably harder in a place like Ethiopia, where the Euro, where the FX reserves now are just a little bit above the 1.1 billion maturity of their Eurobond that matures in December next year. So they have the money to repay this. So I think this is a comment that should underscore that and should reduce concerns in the market.
Looking at it, if this is essentially a willing buyer, willing seller transaction, at least at face value, if the government comes back and says, listen, we're going to buy back parts of the debt and we're offering, I don't know, let's say 97 cents on the dollar. If someone's willing to take that rather than redeeming the whole thing at par, why would that be seen as a default?
I don't think it will. The Moody's criteria for a distressed debt default is if this buyback avoids a default. So, the Kenyan authorities have clearly, made clear that they have the money to repay that, they have the intentions to repay that. So, if they had gone out and publicly said, okay, if the investors don't agree to a buyback, then we will default, or there's a high degree of likelihood that we will default on the bond, then that would fulfill the second criteria, the first criteria of a buyback being necessary or being a way to avoid a default. And the second distress default criteria of Moody's is if the buyback is at a substantial discount to par. And as we just talked, it's trading at 96% to the dollar now. So the Kenyan 2024 is trading very close to par. And I think it's worth mentioning that a US Treasury bonds, which is seen as the safest instrument in the world, issued at the same time as a Kenyan as a Kenyan 2024 and 2014 would also be trading at par just because US interest rates are higher now. So I think it's quite clear that a default, buyback now would not be viewed as a distressed debt exchange. So I haven't seen the exact questions and the answers of the Moody's the report or the comments to Bloomberg last week or 2 weeks ago, but I would take that with a bit of a pinch of salt.
All right then. So when it comes to raising the money, though, because market access has been problematic ever since the pandemic hit. Raising dollar debt in particular has been, at fairly expensive rates. Kenya's borrowed, I believe, from TDB at closer to 9%. There was $500 million raised recently, although we don't know what the price of that was from RMB and Stanchart, among others. But is it feasible now to try and explore raising capital in other markets, perhaps a samurai bond, raising cash in the yen and then using that to essentially settle some of the obligations, or rather settling some of the 2024 bond?
I think it's a good avenue to explore. I mean, I can't say exactly what the issuance yield would be in these markets, how much actual demand there is for such an instrument. I mean, the US dollar ones is traditionally where there's been the most demand and where you have the lowest spreads. But it's, if you look, you see the US rates are significantly higher, the treasury rates, than what you see in Japan or Switzerland or in the EU. So I think exploring different options there is, and I think there's still a strong case for a multilateral guarantee, just to not sort of avoid a default here, but to sort of support the longer term maturity, longer term sustainability of Kenyan debt. Because of course, after the this is the big one, is in June 2024, the 2 billion coming due then, but in the following years, there's significant syndicated loans and the 2020 other Eurobonds that need to be refinanced. So even if Kenya meets this maturity in June next year, doesn't mean they're out of the woods.